All right, folks, part 2 from chapter 4. So notice, here's what's happening. We want to show the financial statement effects. So before adjustment, oops, don't do that. I want to do this, highlighter. Okay, before adjustment, we had $600 in our account. We make our adjustment by lowering it. Now we have $250 left. This is on the balance sheet, right? So basically, we showed that we used up part of our asset. Now, on the income statement, what do we show? Okay, we didn't show anything for supply expense, and now we have a $350 expense. Okay, so that's what happens. The balance sheet goes down, income statement expense goes up. Okay, here's another one. Rent benefits expired during the period. So 3 months rent were prepaid on September 1st for $7,200. But 1 month has now expired. It leaves 2 months left. Okay, so here we go. September 1st, we had $7,200. Now, September 30th, we have to recognize this $2,400 in rent. Okay, these two items over here, these are still left in prepaid. This hasn't been used yet, but we need to show this rent expense. So it's going to go from prepaid to rent expense. So we're going to lower that prepaid by $2,400, right? All right. What type of account? Question number 5. What type of account is prepaid rent? And what adjustment is made? What expense account get adjusted? Okay. Don't forget, write this one down, and it'll be on your quiz up on Canvas. All right, so here we go. Let's take a look at this. So notice, we're lowering our prepaid rent by $2,400. Rent expense increases by $2,400 right here. Lowers our net income. And here's the actual record, right? Prepaid rent expense, we're increasing our expense. We're lowering our stockholders' equity by $2,400. And we're lowering that prepaid rent because remember, we only have, if you take a look now, we had $7,200, then we used up September, and now we have $4,800 left. So remember, prepaid rent is an asset. So to lower it, we lower it with the credit. And there you go, right there. There's the credit. Rent expense increases with the debit. Notice it says AJEB, AJEB. This is so we know where it came from. That's an adjusting journal entry, and our adjusted balance now is $2,400. Okay? Now the next one is depreciation. Okay? So depreciation is recorded for the use of equipment. Okay? So what depreciation is, let me explain. Let's say a company buys a computer for $2,400, and they think the computer is going to last them for 2 years, right? So you got $2,400 and you got 2 years. Now, if we just put this expense all in the month, let's say we bought it in August, right? And we put all $2,400 of expense in August, that wouldn't be showing things correctly because we're going to use this thing for 2 years. So instead of showing all $2,400 in August, we need to show $100 per month. And basically, it's an allocation process. It's an allocation process of taking the cost of an asset and spreading it out over the time that you're using the asset. So notice it says allocating the cost of buildings, vehicles, equipment to the period in which they're used. And what happens is we use something called a contra asset account. Contra, by the way, contra means opposite, to offset or reduce the account. So notice, so for example here's Noodle Cake, there's their balance sheet as of a certain day, right? They had $9,600 in equipment. And then they had accumulated depreciation of $400, which now shows the net amount left of $9,200, okay? So by the way, this is the original cost. It's important to have. This is the running total of all the depreciation. And this is now what's called the book value or the carrying value of the item. Okay? So notice what happens here. Here's our computer. And here's our contra asset accumulated depreciation, $400. By the way, when you hear contra asset, if an asset increases with a debit, asset increases with a debit. A contra asset, contra meaning opposite, increases with just the opposite. So it increases with the credit. Okay? So if an asset increases with the debit, a contra, an against asset, increases with the credit. Okay? So here you go. Let's take a look. Estimated to last 2 years, $400. So what they did, here's what they did. Let me just change to my pen here. It's a pen. So here's what they did. They said we had equipment $9,600. That's the cost of the equipment. They said $2,400. I mean 24 months. So that means divide that and you come up with $400 per month. So what they're going to do is that accumulated depreciation is going to increase by $400 a month, okay, lowering the value. So now let's go back over here. Accumulated depreciation. By the way, this means contra asset. So we're increasing a contra asset, $400. It's actually lowering the asset. And then we have depreciation expense of $400. And this depreciation expense, this is how we put it month by month by month. So notice we increase the rent, expense, lower stockholders' equity by $400, and we increase accumulated depreciation and lower the asset. So here's accumulated depreciation. Here's our adjusting balance. We're now at $400. Here's our depreciation, adjusting balance $400. And now our unadjusted balance here was $9,600. And now once it's adjusted, when that adjustment is made, what's going to wind up happening? See this accumulated depreciation? See, this account is related to this account. These two accounts, they're related. So what's going to happen is it's going to show it. Let's see if it's back here. Yeah, see, they're going to show it just like this. There you go. See, this is where we were. This is after the first month. And so this is our carrying value or our book value. By the way, after the next month, what would happen? It would be like this after the next month. It would say $9,600. That would still say the same. That'd be the equipment number. Now the accumulated depreciation, it would go to $800. And then the net amount, that would be $8,800. So you see, we're constantly using this up. Okay? There you go. All right. Accumulated depreciation is what type of account? We just mentioned it. What financial statement would you find it on? Okay. What's it related to? Accumulated depreciation. What type of account is it? And where would you find it? By the way, that's not question number 1. That should be question number 6. Question number, go back here. Question number 6. Got to get these questions numbering right. Okay. All right, so now all they're doing here is they're showing you a little bit about depreciation. So accumulated depreciation is on the balance sheet. Depreciation expense is on the income statement. That's how we allocate it, okay? Notice accumulated depreciation, you have equipment at its original cost, and then you have the total amount depreciated. By the way, these will also be, notice up here it says note 1, note 2, note 3, note 4, okay? What they're telling you here is that they're going to show you in the notes, they're going to explain how you're doing this because it depends on the depreciation method used. So when you make financial statements, you have to tell people, hey, this is the method we use to do it, okay? Because there's different methods. Now, we haven't talked about them yet, but there's different methods, and the business gets the opportunity to pick the method, okay? So they don't have to do it a certain way. They just have to be consistent about the way they do it. So you have to write notes so that somebody that's looking at your financial statements can say, oh, we understand you're doing it this way, okay? You're using this method for depreciation. Oh, this is how much you paid for it, okay? So here, it's the same thing. Actually, I'm going to stop it right here. We're going to come back. I'm going to make this I think it's part 3 from chapter 4. Okay, I'll be back in just a minute.